Market structure is the foundation of every swing trade. The problem is you've been taught it completely wrong. You're waiting for a break of structure, a retrace into a swing point, and then looking for continuations from your strong low. However, that is not what price is doing. It's not how price moves, and it's keeping you out of 5-hour swing trades, just like this EURNZD short. So I'm going to run through exactly what traditional market structure would tell you to do, but actually what the market does and how to capitalize on it. Let's get into it. So first and foremost, we're looking at 12-hour price action. We're going to use this as our execution time frame, but crucially what we want to do is pair that with higher time frame candle behavior, because that's what actually moves markets. But before we get into it, let's look at the traditional way of mapping market structure. So if you were looking at this market on just the 12-hour time frame, you might mark this as a swing low that then gets closed through. So we have a retrace into some sort of structure. Price then breaks below with a candle close. So as soon as price then retraces, you have a break of structure, but price just takes off. Then we get a retrace, and we're now looking for continuations. So we're expecting highs to be closed through, or this point here to be closed through. That would then create a strong low in the market that we could then trade from. But that obviously doesn't happen. Price tests this area and then breaks structure again. So while we haven't broken structure because our swing point is down here, we do have a break through some structure. So we're looking now for shorts, but again, we get no opportunity to get involved. And what actually ends up happening is our strong low in the market, or our swing point here, never holds. It just gets smashed with a close. So now we're looking at this as a new strong high in the market. How do you trade this? It's practically impossible. You get no retest here. When we do break structure here, you get no retest. And then what you're relying on as your strong low just gets traded straight through. And that's because this is not how price moves. Price moves in accordance with higher time frame candle behavior, and specifically accumulation, manipulation, and distribution. That's how to read price action, and that's how to frame your market structure thinking. So I'm going to do something very simple. I've got the 12-hour time frame. I'm going to overlay the 1-month candle. And what we can see straight away is something very, very different. When price retraces here, it's at the point that a monthly candle closes. So you see this entire bearish monthly candle is sitting behind the 12-hour price action. So when price retraces, this is the initial movement of the new candle that opens. Price then dumps. Where does it dump into? The low of the previous monthly candle. So price is not breaking structure to the downside. It's not closing here for you to then look at continuation shorts. It's manipulating a previous monthly candle range. So then when price breaks structure, and actually truly breaks structure at this point here, what this is signaling is actually that price is now bullish. Where's it potentially going to target? Well, we can infer that from the lower time frames. But for now, let's just stay on the monthly chart. So we see this bullish candle print. What then happens is, as price retraces, again, this is a new monthly candle printing. Price then again trades into where? The high of the previous monthly candle. It then shifts, we come back in as a retest, and then price melts. And what we're seeing here is classic price action, accumulation. So price has accumulated, then price manipulates. And I'm talking about the monthly time frame here. We see candles breaking above the previous monthly candle range. What are they doing? They're raiding the external range liquidity at the high of the previous candle. Now, this candle, as soon as it closes at this point here, has one target in the market, and it is the low of the accumulation candle that it has manipulated. So this is classic accumulation, manipulation, and then aggressive distribution to the opposing range low. So when you're looking at this as a strong low in the market and price is dumping towards it, If you're even considering longs, you're so far behind what the market is telling you, and you're about to get stopped out, that it is, just not worth your time. So actually, you need to understand how price moves in the market. Accumulation, manipulation, close inside previous candle range, and dump. So your job as a swing trader is to understand what is happening on the higher time frames and align your execution time frame and your executions with that narrative. Now this is where it gets super interesting. What I'm going to do is overlay the 2-week candle. So this is going to be, for the purpose of this video, our reference point for actually taking trades. So if I take the monthly candle away, what do we now see? So price breaks below here, a previous 2-week candle range, and it explodes. Then we see price retracing, but we have the monthly candle here. So we have, at this point, accumulation, manipulation, and price is targeting the high of the previous candle range right here. So we're not expecting shorts as this candle retraces, we're expecting longs to this point. But as soon as we then get a fresh manipulation of the monthly candle, we can then look at our lower time frames or our intermediate time frames to look for shorts or trades. And this is what happens. As price breaks into the previous monthly candle high, the 2-week candle closes at this point here. What has happened? It's a 2-week accumulation, manipulation. So now we have what? A new target in the market, an intermediate target for price to target, which is the low of the retracement that you're looking at. So as price is retracing here, if you're now looking for longs off this structure, you are mistaken. Price has accumulated, manipulated, and as this candle is opening, its one job is to distribute to this immediate target in the market. But remember, we're also liquidating a monthly candle. So this also means there's a higher time frame target for price, which happens to be traditional market structure thinkers strong low. So let's take the monthly away. And how do you actually execute on this? So it's then looking at internal range liquidity. Unless you want to go down time frames, this is how to trade it. So this price action creates bearish momentum in the market. So this is our order block. It's the last buy before the sell. And we also get the formation of bearish fair value gaps at this point here. So I'll mark that in red. So let's imagine you're looking at price action here. Bearing in mind, at this point, you have no 2-week manipulation. And if you bring the monthly candle back, we've actually manipulated a previous monthly candle range. So this is not something you'd want to short because you have no fresh manipulation. You have a target in the market that you're aiming for. However, as soon as price closes at this specific point here, you have a 2-week manipulation. So now we have this target in the market that is exposed. So we can remove this here. We can see price is sitting in the order block. But what I would want to see is fresh order blocks being created or fresh liquidity that we can trade from within this 2-week candle. So what then happens? Price dumps and creates a new 12-hour order block right here. It's the last buy before the sell. We see a sell candle through the bullish candle. This is an order block, the last buy to sell. What does price then do? It retraces in but respects the newly created swing high, which is sitting here. This is the swing high because it's the high of the order block in the most recently created bearish price leg. Then what does price do? It creates a new swing high. Price dumps, and importantly, what do we get here? We get the formation of another fresh 12-hour order block, buy to sell. And most importantly, we get the formation of a bearish 12-hour fair value gap. So if I just take away the 2-week candle now, we have buy to sell, fresh inefficiency in price, the inefficiency between candle 1 and candle 3. What is price going to do? It's going to trade in, fill the inefficiency, respect the swing high, and dump to where? The 2-week accumulation candle low. Let's bring that back. So that's exactly what happens. But because we have the monthly on side, we can hold this all the way to this low here. And this is what happens. I mean, you could have traded this 3 times, but let's say that you get the first candle when the new 2-week candle opens to this low, that's a clean 2R, to the monthly low, it's a 5.91R. Okay, that's entry 1. Let's say that you get in next. You want to actually just take the fair value gap because you don't want to miss this trade. You can either set your stop here at the swing point, or you can maybe account for the fact that this area has been liquidated. So you could have your stop somewhere like that. But even if we just cover the swing point, this is a very low stress trade for a swing trader. You've got a very easy 1.35R to the low. So this is, something that you might want to take. But the interesting part comes when you hold this to the additional low in the market that becomes a target as soon as the monthly candle closes. So you're front running the monthly close on the basis that we have our 2-week manipulation and we're manipulating a monthly high. What do you get? Nearly a 4R trade, and that's such a low stress trade. Again, you get more opportunities. Here is a new fair value gap and a new order block. So again, you could have got in for another opportunity here. There's the order block. There's the fair value gap. It's slightly small here. If I take away the 2-week, you can see we have new buy to sell, fair value gap. What does price do? It comes in, tags the inefficiency. And again, if you cover maybe the previous fair value gap, you can even hold this slightly beyond the original target for a clean 2R, anticipating that we'll get some breakthrough structure. But if you again want to hold this, then you can. And what do you get? 5.78R trade. And the important part in all of this is you're not waiting to see if this is something that you want to trade. You're not waiting to see if this is something you want to trade. You are reading candle behavior at the point it closes and reacting and front running the market in the way that you should, not waiting for old structure down here to give you an entry and sitting on your hands the entire time. This is how to trade the market, I promise you. Accumulation, manipulation, distribution. This is how to read market structure correctly, and I've got a lot more information. But before we get to that, let's take a look at how gold actually launched off of its initial low at 2,500 before it went on this monster run, because this is going to give you even more context. So actually, before I do that, what do we actually see here? So we see a structural break in the market. If we're just reading price action here, we have price initially breaking higher, so retracement, extension. So again, you're waiting for shorts here, you get absolutely smashed. Then price retraces into this area here. Where are you targeting? Continuations. They never come. And then your strong high up here, again, just gets smashed. I don't even need to explain it. It's not reliable. So what do we do instead? Let's bring over the monthly candle. So when price is retracing here, we have a monthly candle that closed bullish. We have another monthly candle that closed right here above the previous candle. So you see this candle closed above the previous monthly candle. So at this point here, we're bullish, but then we see price action start to shift. I'm sure that would have showed its hand on the lower time frames. Let's just stick with the monthly for a second. Why does price actually retrace? It is to fill the monthly fair value gap. Because if you see, and this is going to take some training to get your eye in, this is the high of a monthly candle. Price then breaks up and closes, then a new monthly candle is formed. There is an inefficiency in price on the monthly time frame between candle 1 and candle 3. So what is price doing? It's retracing to fill higher time frame internal range liquidity. We can see that on the monthly time frame. Price then closes inside the previous monthly range. So what has price now done? It has liquidated the previous monthly candle range. That exposes this high as our higher time frame target for price. Price is going to base and target what you think is a strong high in the market. How is it going to do that? Again, let's just look at the 2 weekly, because we can get into the weekly time frame, but that's something that is in my playlist. I want to just focus on 2 week time frame right now. So what does price do? We get a manipulation of this accumulation candle. So price trades into the high here. Everyone thinks the next move for gold is starting. It's not. We close here. Where is the current 2 week target for price? It's down here. But the monthly is against that trade. So if you're waiting for distribution here, you're actually you're trading against what the monthly time frame is saying. So sit on your hands. What then happens? Fresh 2 week manipulation. This is now a target for price. Why is it a target for price? Because we have accumulation, manipulation, price drove into the low of its previous 2 week candle and closed inside. So this is now structure confirmed. What do we then get? A bullish 12-hour price leg. Okay, this is so clean for us to trade. We have what? The last buy, sell before the buy, sell to buy. That's our order block. Then we have bullish fair value gaps. The most recent in the leg is there. Okay, so let me just drag this across. Sorry, it's so small, I can't get to it. Okay, so let's just mark that green. So at this point here, when this candle closes, we have the formation of a bullish price leg. However, we are reacting from a previous 2 week high, so we could see some resistance here. But ultimately, your first entry could be off the fair value gap. The only issue with that is you would need to hold below the swing point, really. But still, to this point here, that's a 1.38R trade. However, you have another fair value gap here, and ultimately the order block. So if you take the trade from the order block, 3.78R trade. If you take it from the middle fair value gap, 2R trade. But where this gets interesting and where you don't need to fight the market is you already have the monthly on side. So I wouldn't worry too much here about execution. I would just want to get involved. So let's say you take this trade. You're not aiming for the 2 week high. You're aiming for the monthly high, 3.76R trade. And even if you take this off the first fair value gap, still a 2.5R trade. That's an amazing return on a low stress swing trade. This is how the markets move, I promise you. Accumulation, manipulation, distribution. What your job is as a swing trader is to align timeframes. Is to find the narrative between the weekly, 2 weekly, monthly time frame, to execute on a time frame that makes sense. I personally love the daily and the 12-hour. Sometimes I'll also look at the 6-hour. And then it's to execute with precision at the right time. I have a 30 video, 3-part series on my YouTube channel that walks through this end to end. Gives you everything you need to go from a novice swing trader to someone that can execute these trades at scale. And the beauty is, because you're looking at the 12-hour time frame, most of your time then becomes analysis, not execution, which is really important. And what you'll see here is I have a trading list with tons of pairs here, 30, 40 pairs. And I can scan through this in literally 15 minutes, around 10 a.m. in the morning, or, you know, this translates into the New York session as well. And I can just look to see what's active, where do I need to set my limits, what makes sense, and then I simply trade the markets in a way that makes sense. Accumulation, manipulation, distribution. So this has been a detailed guide on how to effectively read market structure and what not to do, the traditional way of reading market structure. Please subscribe to the channel, check out the playlist, and I've got so much more coming. See you on the next video.